Invest in what you know is the investing philosophy taught by Peter Lynch in his book One Up on Wall Street. In this book, he explains that you must invest in companies and businesses that are around you and you use them on daily basis. And of course, follow it up with further fundamental research. So when I started looking at things I use, I realized that I am writing this article on Microsoft Docs, I'm researching using Google, I'm going to shoot it using a Sony camera, and I'm going to upload it on YouTube. And after the shoot is done, I'm probably going to go and watch the Spider-Man movie. So basically, all of these businesses are owned by foreign companies. So should I invest in foreign stocks? If you are wondering this, please do watch this video till the end. Namaste, this is Akriti Agarwal and welcome to Wealth Cafe's YouTube channel where we help you make smarter money decisions. So if you are someone who has built a decent portfolio by investing in equity either directly or through mutual funds in India and are looking to diversify geographically or basically invest in companies around you, then you must be looking at foreign stocks. Now, when I say of foreign stocks, there are numerous countries and exchanges that are available to me, such as Shanghai Stock Exchange, Tokyo Stock Exchange, Hong Kong Stock Exchange, London Stock Exchange, and of course exchanges in the US. Now, of all these options, the most obvious place where one would start investing is the US Stock Exchange, because US stock exchanges are the largest stock exchange in the world, comprising of 40% of the world's stock exchanges. Yes, and some of the most innovative, unique and largest companies in the world are listed on these stock exchanges. For instance, the top 5 companies on the US Stock Exchange, earlier known as FANG and now abbreviated as MAMA. Yeah, right. Meta, which was earlier known as Facebook, Apple, Microsoft, Amazon, and Alphabet. So their market capitalization is 3x the market capitalization of all the companies listed on the National Stock Exchange of India. So you can just imagine how large the US Stock Exchange is. And apart from this, you know that the companies that dominate the National Stock Exchange of India are basically from the traditional sectors such as banking and finance, pharmaceuticals, FMCG. So we still have to catch up with the US when it comes to innovation and tech companies. Now, apart from this, when one is investing in the US, you're also managing the risk of your entire portfolio. It is always advised that when you're investing in two different assets, ensure that they have a negative or a zero correlation. And when we compare the US Stock Exchange with Indian Stock Exchange, their correlation comes to 0.36, which basically means, as you can see in the chart here, that the years when the Indian stock exchanges performed well, the US stock exchanges also did very well. But the years when the Indian stock exchanges did not perform well, having US stocks in your portfolio definitely did good for you. Now, along with this managed risk, the third reason is of course high returns. When we compare the 3-year, 5-year and 10-year Dow Jones returns with Sensex, we've seen that the Dow Jones have performed better. So yes, we are getting the innovation companies with higher returns. And to add to this higher returns is rupee depreciation. So I'm sure you must be knowing that what is the value of $1 when it comes to rupee, and this has been increasing over the years. So 10 years ago, the value of $1 was 54 rupees and today it is around 75 rupees. Basically, there has been a 3% year-on-year depreciation from the past 10 years, and this gets added to your profit when you invest in US dollars. Basically, when rupee depreciates further, the investments on our returns in US stock increases. So you can see that when one is investing in US stocks with managed risk, you're also earning higher returns and also enjoying through rupee depreciation. So definitely investing in foreign stocks seems like a lucrative option. But do not forget that when you are investing in equity, whether it's India or foreign, it should fall within your asset allocation based on your risk profile. So where you're a growth profile, 70% of your portfolio can be invested in equity, and within this allocation itself, you should park some money aside for foreign stocks. It's not like, you're investing your debt portion to foreign stocks. Secondly, do your research. right? There is ample of data available when it comes to US stocks. So where you have the time, skill set, and the ability to do the research, do your fundamental analysis before you start picking stocks. And you can invest in US stocks easily with some of the platforms which are available in India. We have given details of them in the description below. And where you do not have the time and ability to invest in these stocks directly, mutual funds is the way. Mutual funds are a great instrument to invest indirectly, whether in Indian stock market or foreign stock markets. So I hope that you would follow your basic fundamental analysis and give respect to the fundamental rule of high risk, high returns and low risk, low return when you're exploring foreign stocks. If you know someone who's been exploring to invest in foreign stocks, do share this video with them. And don't forget to like, share and subscribe. And watch out this space every Wednesday and Saturday as we bring freshly brewed content only for you. Until then, don't forget to save hard and invest smart. Thank you so much.